Welcome to vTalkInsight, Market Drivers Daily for August 12, 2026. AI infrastructure earnings are roaring back just as oil, geopolitics, and inflation risks begin to tug in the opposite direction. Today we will look at how the AI build-out is driving a renewed tech rally, how energy tensions are reshaping the macro backdrop, and how a powerful earnings season is doing the heavy lifting for equities. AI remains the main engine behind equity risk-taking today, but the story is shifting from pure hype to very real cash flows and equally real financing and valuation risks. Strong results across the AI infrastructure stack are lifting indices again, even as questions build about how long this pace of capital spending can continue. CoreWeave and Supermicro sit at the center of this move. CoreWeave has now reported record revenue for several quarters in a row, supported by a triple-digit billion-dollar backlog and tens of billions of new commitments signed in a short window, signaling deep demand for AI compute. Supermicro has raised its revenue outlook well above earlier expectations, citing persistent demand for NVIDIA-based servers and tight compute supply. Orders tied to hyperscaler AI projects are also driving strength in optical components and networking, with large cloud clients placing multi-billion-dollar orders for AI-related infrastructure. This micro picture is feeding directly into global equity performance. European indices are hovering near record highs, helped by a string of gains and firm earnings from technology names such as ASML and ST Micro, while more defensive areas like large pharmaceuticals underperform. In Asia, Korean equities have surged roughly 4%, supported by upbeat earnings and reports of potential strategic investment in a Samsung and SK Hynix alongside strong AI chip and memory demand. At the same time, Europe more broadly is still often treated as an anti-AI and energy-sensitive trade, underlining regional divergence inside global portfolios. Compared with earlier this week, when attention was squarely on how the AI CapEx cycle would be financed, today's news flow shows revenues and margins starting to catch up. Yet the financing backdrop has not gone away. Debt tied to data centers and hyperscaler projects is expected to rise sharply into 2027, with estimates of hundreds of billions of issuance from the largest platforms alone. AI-related debt spreads have already widened more than in other sectors, and investors are increasingly focused on issuer concentration and the bond market's capacity to absorb that supply at current yield levels. Many high-profile AI companies still have thin or negative free cash flow despite rapid top-line growth, keeping bubble concerns alive. Norway's sovereign wealth fund, which just posted its strongest quarter in 6 years on the back of global technology and AI exposure, is already signaling more caution on AI valuations and geopolitical risks. For portfolios, the main implication is rising dispersion rather than a simple one-way AI trade. Correlations within the S&P 500 are at multi-decade lows, and leadership is broadening beyond the original Magnificent Seven toward financials, healthcare, and industrials seen as AI beneficiaries. Equity indices are being driven less by multiple expansion and more by earnings beats and upgrades, but the gap between winners and laggards inside tech is widening, and leverage plus concentration in a handful of semiconductor and infrastructure names keep the risk of rotational shocks high. Looking ahead, NVIDIA's upcoming earnings are a clear inflection point. Consensus is for exceptionally strong revenue and profit growth, so any hint of slower demand or more cautious guidance could challenge the latest AI-led rally. How AI-linked credit spreads, term premia, and evidence of genuine productivity gains evolve from here will go a long way to determining how durable this cycle proves to be, and it sets the stage for how macro risks around energy feed back into valuations. Energy and geopolitics remain the key macro wildcards, with the Middle East, Russia-Ukraine, and climate-related disruptions all tightening supply just as inventories are being drawn down. The result is an embedded energy risk premium that now sits alongside otherwise strong growth in earnings. Oil prices have risen for several consecutive sessions, with Brent trading close to the upper end of its recent range and up in low double digits on the week. The International Energy Agency now expects global inventories to fall more than twice as fast as previously forecast this quarter, implying a sizable daily shortfall at a time when strategic reserves, particularly in the U.S., are at multi-decade lows. The Strait of Hormuz remains the crucial pressure point. Negotiations to reopen it are described as advanced, yet there is still no formal agreement, and reports of potential compensation demand from Iran for certain vessels add a fresh layer of complexity. Ships transiting the area continue to face threats from both Iranian and U.S. forces, keeping maritime risk high. Traders are skeptical of official claims that flows are running near 9 million barrels per day, and even with ship-to-ship transfers and alternative routes, Gulf exports remain below pre-war levels, helping to keep crude, diesel, and jet fuel prices elevated. Russia's war in Ukraine is amplifying these pressures. Drone attacks have disrupted Russian oil and grain exports, pushing overseas crude shipments to their lowest level in months and sending wheat prices sharply higher. Ukrainian strikes on refineries have forced Moscow to import gasoline from distant suppliers such as India, highlighting domestic fuel shortages, while grain exports through the Black Sea have fallen dramatically, with Ukraine's August shipments down about 75% year-on-year. These supply shocks are feeding concerns about renewed food and energy inflation, especially in more vulnerable economies. Europe sits on the front line of many of these dynamics. Gas prices there remain more than double pre-war levels and are expected to stay elevated given constrained liquefied natural gas flows and limited pipeline alternatives. Repeated heat waves, low river levels, and jellyfish blooms are curtailing nuclear output and hydro capacity just as demand for cooling surges. Wholesale power markets have become more volatile, and demand destruction is increasingly seen as the main rebalancing mechanism for gas. This reinforces the view that Europe faces a structurally higher energy cost base than the U.S. and is therefore more exposed to growth headwinds and policy mistakes, a theme that also shapes how investors frame Europe as an anti-AI and energy-sensitive equity allocation. For markets, the critical link runs through inflation and rates. Persistent strength in energy prices, combined with low strategic reserves, raises the risk that headline inflation reaccelerates into year-end. Rising diesel prices in July are likely to show up in August data, and higher jet fuel costs affect travel and freight, making it harder for central banks to simply look through these shocks if they are seen as entrenched rather than temporary. That could limit how dovish policy guidance can become and would test the resilience of both European equities and fixed income. The counterpoint is that, so far, this looks like a premium rather than a full-blown shock. The global economy is less oil-intensive than in past cycles. China has cut imports by several million barrels per day, and alternative routes are keeping some flows moving even through high-risk regions. Futures curves in some commodities still imply expectations for prices to drift lower, and pass-through from higher input costs to final consumer prices has been partial outside sectors like airlines and hotels. What happens next will hinge heavily on politics, from Iran's more assertive military posture to election-driven debates over energy policy and tariffs. For portfolios that suggest headline-driven volatility around oil, gas, and related assets is likely to persist, and incoming data on inventories, Hormuz negotiations, and European power prices will be key signals as markets weigh the strong earnings backdrop against these energy risks. Against this backdrop of AI enthusiasm and energy uncertainty, earnings remain the strongest pillar supporting risk assets. Across regions and sectors, results are coming in well ahead of expectations, and that earnings power is doing much of the work offsetting concerns about geopolitics and valuations. For the S&P 500, reported numbers have been exceptionally strong. Underlying earnings grew roughly 25% in the second quarter, with around 85% of companies beating earnings per share estimates and about 3/4 exceeding revenue forecasts. Profit margins are approaching 17%, up markedly from around 10% 5 or 6 years ago, and consensus expects similar earnings growth again in the third and fourth quarters. Importantly, valuations have not simply stretched to accommodate this. S&P 500 multiples have actually contracted by roughly 10% this year, meaning earnings growth has done most of the lifting. Tech and AI-linked sectors are still central to that story, with record beat rates in technology aligning with the revenue and backlog strength we discussed earlier in AI infrastructure and semiconductors. At the same time, leadership is broadening beyond the original Magnificent Seven, as financials, healthcare, and industrials attract interest as more diversified beneficiaries of AI and CAPEX-led growth. Outside the U.S., the pattern is similar, if not stronger in places. European equities are trading near record highs, helped by a run of gains and solid results from technology names such as ASML and ST Micro, alongside banks like ABN AMRO, which has delivered over 50% share price gains over the past year on the back of cost discipline and upgraded income guidance. In Asia, Korean stocks have rallied sharply, with the Kospi up around 4% on strong earnings and renewed confidence in AI-related chip and memory demand. Even in consumer and restaurant names, companies like Kava and Brinker are reporting better than expected sales and profits, suggesting discretionary spending remains resilient despite higher prices. The challenge is that expectations have now reset higher. Recent strength has eased some earlier overvaluation concerns in large-cap growth, but conviction in further multiple expansion is weaker than it was a few weeks ago. Many prominent AI companies remain unprofitable despite large revenues, feeding bubble worries, and some areas of demand, such as smartphones, are not yet showing clear uplift from AI features. Markets have also seen how quickly sentiment can reverse. Even a record year and strong legacy cash flows have not insulated some large tech and communication names from post-earnings pullbacks when guidance disappoints. From a portfolio construction standpoint, that puts the emphasis squarely on earnings revision trends and dispersion rather than just headline index levels. Correlations inside major benchmarks are at multi-decade lows, and the gap between sectors and individual names that are beating and those that are missing is widening. Robust profit growth provides a cushion against shocks from energy or policy, but it also raises the bar, meaning disappointment from highly owned names can trigger outsized moves. The near-term focus now is on upcoming reports from NVIDIA, Applied Materials, and other bellwethers in chips and software, which will help determine whether the earnings-led rally can extend into the autumn or whether higher yields, energy costs, and already elevated expectations begin to cap the upside. To sum up, AI infrastructure earnings are once again driving a powerful tech-led rally, but with rising leverage, wider credit spreads, and growing focus on cash flow, markets are becoming more selective about what counts as quality AI exposure. At the same time, energy and geopolitics are rebuilding an inflation risk premium, particularly for Europe, just as global earnings deliver some of the strongest growth and margin profiles in years. For now, earnings and cash generation are doing the heavy lifting in keeping equities resilient against higher oil and lingering macro uncertainty. But dispersion across regions, sectors, and single names is widening, and the next wave of AI and energy data will be critical in setting the tone. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.